Required minimum distributions, three words that can sound scary, but under current law, RMDs don't begin until age 73. For many retirees, they're more like a rain cloud to navigate, not a storm to fear. Hi, my name is Ben Lockery. I'm a certified financial planner. Before launching Lock Wealth, I spent 10 years at Capital Group and Invesco, helping investors plan for retirement. If you're looking for more personalized guidance, I am currently taking on one new client a month, and you'll find a link in the description if you'd like to connect. Over the years, a lot has shifted. Back in 2017, a married couple, both age 65 plus, could protect about $23,300 of income before paying federal tax. That number included the standard deduction, the age 65 add-ons, and personal exemptions. By 2025, under current law, that figure is closer to $46,700 thanks to a new senior deduction, which does have income phase-outs. For single filers age 65 plus, the numbers went from about $11,950 in 2017 to about $23,750 in 2025. These figures are federal only and assume full eligibility under current law. Not only are today's tax rates lower than pre-2018 levels, the brackets are wider because of inflation adjustments. That means you can earn more before moving into the next marginal rate. And remember, only the dollars above each threshold are taxed at the higher rate. RMDs used to begin at 70.5. Today, they begin at 73, and under current law, they'll rise to 75 in 2033. Future legislation could always change that, and for now, that's 4 to 5 years of flexibility. At age 73, the IRS Uniform Lifetime Table gives a divisor of 26.5, meaning a withdrawal of about 3.77% of your account. That's slightly lower than the old rules. So over retirement, it often means less in forced taxable income and more flexibility in timing withdrawals. Special tables, of course, apply if your spouse is more than 10 years younger or if you inherit an IRA. Put those changes together, larger deductions, wider brackets, later start ages, smaller withdrawal percentages, and the tax picture looks very different than most people expect. One real challenge is widowhood. At age 73, a $500,000 pre-tax account produces an RMD of about $18,868. A $2 million account produces about $75,472. As a married couple, deductions often shelter much of that income, so most of it falls into the 12% bracket. As a single filer, brackets are much tighter. More of that same RMD can fall into 22% or even 24%. For a $500,000 account, that might mean an extra $1,000 to $2,000 in federal taxes each year. For a $2 million account, it could mean $8,000 to $10,000 more per year. These are federal-only examples. State taxes and Medicare IRMA can make that impact a little larger. In most cases, though, a surviving spouse rolls the IRA into their own name and continues using the Uniform Lifetime Table, which is what I've shown here. If the spouse instead remains a beneficiary, or if they're more than 10 years younger than the original account owner, different tables apply and the required withdrawals can look very different. The key is knowing whether you're closer to the 500,000 camp or the 2 million camp, and planning calmly, not out of fear. So how do you plan calmly? Here are 4 approaches that can help. First, blended withdrawals. Take modest amounts from both taxable and pre-tax accounts earlier, so future RMDs shrink naturally. Model carefully to avoid nudging into higher brackets or IRMA surcharges. Second, asset location. Place slower growth assets in pre-tax accounts and higher growth assets in Roth or taxable accounts. Benefit, it depends on future returns and tax rates. Third, micro Roth conversions. Instead of one large conversion, convert smaller amounts in low income years. Watch for bracket creep, Medicare thresholds, and credit phase outs. Fourth, qualified charitable distributions. Starting at age 70 and a half, you can donate up to $100,000 per person per year directly from an IRA to qualified charities. QCDs can satisfy RMDs when they apply and are excluded from taxable income. The check must go directly from the IRA to the charity. The bottom line is RMDs aren't a storm cloud waiting to ruin your retirement. They're a rain cloud to navigate. And with today's larger deductions, wider brackets, later start ages, and updated RMD tables, plus the right plan in place, you can approach RMDs calmly and confidently. And that peace of mind is what retirement planning is really about.